first thing I will do, and this can be recorded, is I'm going to share on my screen. This is the book we're talking about, The Flash Boys. Everyone can see it, right? The Flash Boys, A Wall Street Revolt. This was published in 2015, but it was about events that happened between about 2005 and about 2013. And I'm going to stop my share at this moment so that I can see my article, but you folks won't be because this is paywalled content. And I'm just going to go over what the basic story is, what we were seeing. Now let's get on to getting into, this part can be recorded and posted. I'm going to get into my slideshow, which goes into some of the concepts involved, because I think I went through this story and it moves kind of fast through a lot of technical jargon. And I want you to understand what actually happens in these markets. So I'm going to screen share my slideshow. Okay, you guys are all seeing the Flash Boys of Wall Street on your screen. So this is based on the New York Times bestseller. And this is the reference to the book. And there was research from several technical experts. So what is high frequency trading? High frequency trading is the use of highly sophisticated computerized trading, offering an edge to those who use it. Computer algorithms. And we also see those computer algorithms in cryptocurrency in the form of smart contracts and some of the contracts in the blockchain. Computer algorithms take a look at a variety of factors, including economic reports and news headlines, to make split-second determinations. There's a lot more code in these algorithms than will fit into anything in the blockchain. So critics of high-frequency trading, including Mark Cuban, you know him from Shark Tank, and author Michael Lewis of the New York Times, have recently brought this risky, powerful trading into the spotlight. In May 2010, when the Dow dropped more than 1,000 points and then regained them in less than 20 minutes, this flash crash was largely attributed to high-frequency trading and programmed trading. High-frequency trading was not regulated in 1997 when it first began to become popular among Wall Street brokerage firms. Since then, the SEC and the CFTC for commodities have introduced some regulations. There are limit up, limit down, daily and hourly limits, and other safeguards. And this happened also in light of the black bag mortgage crisis, which precipitated the decline of 2008 to 2010 and caused a total freeze up in the credit market for a little while. The flash crash of 2010 was another example of this sort of problem, and there were other events in which HFT, high frequency trading, was said to play major roles. HFT is not the same thing as the smart contracts in a blockchain, which are coming under tremendous scrutiny as NFTs and cryptocurrency and stablecoin ecosystems have come crashing down. The term programmed trading does not really describe HFT, as unlike the blockchains and their smart contracts, there are points in programmed trading today where human intervention and regulatory rules and actions can interrupt unwise or downright catastrophic gyrations in the valuation of market assets. Very different from crypto and NFT. So if you want more about how this cryptocurrency and blockchain stuff works, you can see my previous talk, and there will be an upcoming talk to the Chicago Computer Society, which I will make available to the Lexington group in PDF form, and it will be more focused on NFT and these so-called stable coins and why they became much more volatile to the point where they actually have been crashing. So today, much of the activity in high-frequency trading is regulated by SEC and CFTC. But regulation and human intervention were not the rule in Wall Street in 2007 to 2013 when the story took place. So New York Times journalist Michael Lewis said that the problems in the market structure, screw up were unintended consequences from regulations introduced in 2007. It was an accidental conspiracy, Lewis said. I think high-frequency traders are like exploiting a system that's got these glitches in it, and they found loopholes to jump through. It's sort of like blaming the lion for eating the antelope, that they do what they do. So how does high-frequency trading work? Bob Pisani is a CNBC commentator, and he wrote a nice article about this. It was an opinion piece. He says, I've said several times that I do not believe markets are rigged or that high-frequency trading is legalized front-running. I'll explain front-running later. However, I have said that it would not surprise me that there are high-frequency traders who are engaging in abusive or manipulative behavior. Pisani continues, the real focus should be on the strange relationships that have developed between brokers, dark pools, which I'll explain, exchanges, and high-frequency traders that has led to the markets being excessively complex, fragmented, and confusing. I'm talking about developments like paying traders to trade on an exchange, which has led to the proliferation of strange order types that route stocks in confusing directions, including dark pools that do not adequately disclose who is participating in their pools, the obsession with getting as close to the exchange servers as possible in order to have microsecond advantage in trading, the development of trading strategies designed to exploit sub-second strategies, like the use of pattern recognition software to determine the location of large buyers or sellers. This also gets into a practice known as tailgating. This all raises legitimate questions about whether the system is needlessly complex, and if it is, how to reduce the complexity or reduce the number of ways the complexity can be exploited. So let's talk about network latency, the network latency arms race of the 2010s. In 2010, a company named Spread Networks spent $300 million to dig a fiber optic line between Chicago and New York. The sole purpose of this very expensive cable, reducing latency, the time it takes to receive and respond to new information for trading firms. Less than 2 years after its completion, however, the wire was rendered obsolete by more sophisticated technology, a communication network transmitting microwave beams through the air. This one-upsmanship is just one symptom of the latency arms race that has been perpetuated by high-frequency trading, a phenomenon that's been leading to problems long before Michael Lewis dropped his bestseller. High-frequency trading is characterized by traders operating at the microsecond level, using automated computer algorithms to submit large numbers of orders to buy or sell. Some firms use co-location, which I'll explain, placing their computers as close to an exchange's servers as possible. Others rely on dedicated communication lines from companies like Spread Networks. These are lines where you have a literal fast lane that you pay for. Still more firms pay for direct feeds from the exchanges, and they pay a lot. Lewis contends that the US stock market really was rigged, indeed that it still is, with high-frequency traders exploiting their latency advantages at the expense of average Joe investors, like you and I with our retirement funds. Well, the US stock market may indeed be rigged, but it's not just about the high-speed trading. The stock market is rigged because of how current stock markets work. And some research has found that it's rigged against the traders themselves. Virtually all modern financial markets match orders continuously. That is, as orders arrive to the exchange. Continuous time matching is essentially a winner-takes-all race. A high-frequency trader who receives and acts on new information faster than others can readily pick off orders sitting on exchanges. Over 40 venues are competing for the same orders before others can react. So being faster by as little as 1 microsecond is enough to grab all the profit. This is how the Flash boys win. HFTs employing latency arbitrage, which I'll get to, examine current markets. They examine current market information to predict immediate price movements, essentially computing the best prices available before the exchange has even had a chance to update its price quote. What was found in a 2013 University of Michigan study may be even scarier. The article, like Lewis's book, was published in 2014. It's not simply a matter of the HFT crowd taking profits away from regular investors. Predatory strategies like latency arbitrage have the potential to reduce trading gains for all market participants, high-frequency traders and average Joes alike. In The Flash Boys, Lewis tells the story of Iex, a stock exchange which he built with others that was designed specifically to protect investors from predatory HFT strategies like latency arbitrage. The founders of Iex intentionally introduced a 350 microsecond delay to ensure that high-speed traders could not act on updated information from the exchange before regular investors. These are heroes, we are told. But the dominance of sophisticated computer-based trading algorithms is due to the nature of continuous time trading, and imposing a fixed delay may be at best a stopgap measure. The alternative is to match orders to trade at fixed regular intervals, like every second. In such a frequent call market, everyone has until the next time the exchange clears or matches orders to respond to new information. Orders are processed at the same time rather than as they arrive. So the fastest trader no longer takes everything. The interval length can be selected to be small enough to effectively track information in the markets, yet imperceptible to regular investors. At this point, I want to seg back to the original story and give a little bit on the Iex Exchange. This is not paywalled material, so it's okay. The system has incentives for having a latency advantage. So a lot of firms were benefiting from the types of effects that we have seen, and they had incentives not to talk to people like Katsuyama, who are trying to level the playing field. On the other side were firms which had been getting run over by faster firms. Those firms were glad to try something to level the playing field. What Katsuyama and his colleagues decided to do was add physical distance to the path that the traders' signals would take. This could not be done just by using a computer program, partly for regulatory reasons. A bright idea came from a new employee, James Cape, who had just joined them from a high-frequency trading firm. Cape decided, why don't we just coil the fiber? Instead of running straight fiber between the two places, why not coil 38 miles of fiber and stick it in a compartment the size of a shoebox to simulate the effects of distance? And that's what they did. And I have an image of what they did. This is the box, and it has a coil of fiber optic cable. That's 38 miles of fiber optic inside that box. And that's how they introduced the delay. There's other hardware and firmware in there that helps to do this. So the box was kept at a facility in Secaucus, New Jersey. It contains 38-mile coil of fiber optic cable that creates a slight delay in the processing of orders, which levels the playing field among traders. And I give credit for the photo. The alternative to this box would have been to locate a new exchange hundreds of miles from Wall Street, perhaps in Nebraska. Not many Wall Street firms wanted to move to Nebraska for some reason. So A new exchange called the Investors Exchange, which wound up being shortened to IEX, was born. IEX was initially pretty successful, but it never really gained a large share of the securities market. Resistance was so built in that even the SEC had difficulty making reforms. Even the current rules, years later, do not fully overcome the negative effects of HFT and network latency on the financial markets. Eventually, IEX pretty much disappeared from the landscape, and the big exchanges went on with few reforms, but still many systemic inequalities. So the questions are still being debated today. And I will get back to what this debate is about at the end of the talk. So let's get back to what was happening with this Flash Boys. We have just covered the possibility of an alternative to introducing distance, and that is to have regular fixed interval trading, frequent call. Similar to the idea behind IEX, the frequent call market slows down trading by introducing a delay. And matching at regular intervals provides a notable additional benefit. The study showed that frequent call markets offer a significant improvement in trading gains. As Michael Lewis explained so well, exploitative Wall Street behavior has run amok, eroding trust and investor confidence. But we need to understand that the vicious cycle happening at the exchanges, not just the HFT arms race, we need to understand it to truly escape the rigged game. And more references. So at the problem's root, we have something called latency arbitrage. Let me go back to the beginning and just simply answer, what is arbitrage? Arbitrage is an investment strategy in which an investor simultaneously buys and sells an asset in different markets to take advantage of a price difference and generate a profit. While price differences are typically small and short-lived, the returns can be impressive when multiplied by a large volume. Arbitrage is commonly leveraged by hedge funds and other sophisticated investors. These are the big guys, these are the whales. There are several types of arbitrage, including pure arbitrage, merger arbitrage, and convertible arbitrage, and you can look at the references to figure out all of that. In other words, there is an asking price and there's an offering price, or there's a difference between the price on two different exchanges. Arbitrage is the process of reconciling the two price levels to facilitate a sales contract or a transaction. A fee is often paid to the arbitrageur for this service. Arbitrage differs from blockchain smart contracts in many ways, including the fact that there is a human intermediary in many cases. Even if there isn't, the computer programs are much more sophisticated than a smart contract. There are arbitrage funds, mutual funds, which are focused on arbitrage, and you can invest in them, though I would not recommend doing so. I am not a financial advisor, so consult with your financial advisor before taking even my advice. Effects of latency arbitrage. Traders and hedge funds who use high-speed methods to gain an advantage in the stock market impose a tax on other investors, according to a study released in 2020, costing as much as $5 billion per year at that time across global exchanges. The Financial Conduct Authority, FCA, which is a regulatory arm of the United Kingdom, found that the trading practice known as latency arbitrage causes the overall volume of trading on global markets to decrease. Latency arbitrage is one of the ways high-frequency traders profit to the detriment of slower trading investors. It involves arbitraging prices gleaned with a low latency in fractions of a second from certain exchanges. Better prices are snatched up by high-frequency traders before regular investors. The FCA found the average race between firms lasted 79 microseconds. Now, by contrast, I think it takes something like 400 milliseconds to blink your eyes. And only the quickest execute its trade, gaining any benefit. This is where network latency effects can enter into the problem. While latency arbitrage trades on public information, the study found that the negative outcome of such high-speed trading is that it increases the cost for investors to buy and sell shares. Now, I want to emphasize that it trades on public information, so there's not really that much of a question of insider trading. So technically, this is not considered insider trading or the illegal practice of front running, but it is considered very unethical and has led to the development of off-exchange trades in so-called dark pools. One of the key players in our story is BATS, a non-traditional exchange located in northern New Jersey. The exchange today is not at all what it was at the time. So what is BATS? The BATS Global Markets was a US-based exchange that listed several different types of investments, including equities, options, and foreign exchange. It was founded in 2005 and was acquired by CBOE, that ought to be capitalized, CBOE Options Exchange in 2017. Prior to being acquired, BATS Global Market was one of the one of the largest US exchanges and well known for its services to broker dealers, as well as retail and institutional investments. Just a second here. Okay. As an exchange, BATS grew into the main competitor to the New York Stock Exchange and NASDAQ, both of which handled a greater amount of equities when ranked by market capitalization. In 2016, BATS had become the second largest US equities exchange by market share and was the largest exchange traded fund exchange. In other words, there were more ETFs trading on BATS than anywhere else. So I have a reference about that. More key terms: front running and insider trading. Both front running and insider trading impact mutual fund unit holders as well as stock market investors. Front running is a bit different from insider trading, although in both cases, the perpetrators aim to make money on the stock market by trading in a company's shares. In front running, a dealer within an institutional money manager, like a mutual fund or even a share broker, takes advantage of his knowledge of the orders that the mutual fund has lined up for the day and tries to profit from them. So how's this fraud orchestrated? Once the fund manager decides what he wants to buy or sell, he informs his dealer, whose responsibility it is then to execute the trades on behalf of the fund house. Every fund house has an isolated area called the dealing room, in which these trades are executed all day long. Only dealers and fund managers are allowed entry here. And here's where the crime can take place. If the dealer wants to profit, he enters the market minutes before he punches in the order of the fund house. Mutual funds usually place large orders in the stock market. Such orders can sharply move the price of a stock. Here, the dealer buys or sells the stock minutes before a mutual fund places its trades, buying or selling their stock. The idea is to profit from the big investors' moves either by buying or selling the shares before they can. So what is insider trading? Insider trading, on the other hand, is when a company insider, an official, employee, or senior executive, takes advantage of unpublished price-sensitive information to trade in the company's stock and make profits from such transactions. As the name suggests, insider trading is done by a company's employee aiming to profit from dealing in the company's shares. Front running can be done in just about any stocks or sectors by unrelated people who have knowledge of how some large investors plan to trade in the markets. Work from home has made it difficult to keep controls over these practices. And then there's also the term tailgating. Tailgating is when brokers or financial advisors profit by placing orders on their own account using information provided by customers for their trades. It is not illegal, but it is a highly unethical activity. Even though tailgating is not illegal, the SEC can take action against firms that make profits using information provided to them by customers. Now we're going to do a little bit about the networks and how the latency develops. What's shown on this slide is what was the Quest network. And it shows basically how complex the network is and how many different nodes it has. Packets which travel through the network may take more than one path and then be reunited. And so the exact path that a signal will take once it leaves your computer or server and before it arrives at its destination may be highly unpredictable unless you have a dedicated line, which you could pay for at one time. This is a kind of a faint image, but this is the situation that is being referenced in the Flash Boys. There were exchanges that had a point of presence on the trading network that was out in New Jersey, and others that were a little closer. And this is where the NYSE was. But due to co-location, BATS was right here. And the Lincoln Tunnel goes from Manhattan to New Jersey, and the fiber optic cable exits there. And that's exactly where BATS placed themselves. So they had a direct point of presence. There were others who had dedicated lines, and there were others who were 15 microseconds away. There were some who were 97 microseconds away. There were some who were 120 microseconds away. This all has to do with the physics of light in fiber optics, and it has to do a little bit with copper wire. So, point of presence, how point of presence affects latency and what co-location means. Points of presence versus edge locations. A point of presence can be as simple as a single server mounted in someone else's cabinet. Edge locations, on the other hand, are points of presence with full deployments of advanced infrastructure, not just a single service. I believe BATS was more of the second type, less of the first, but they could just as easily have had a single server. Points of presence work very much like internet exchange points, only on a smaller scale. The equipment located at a point of presence can be broken down into 5 categories: base stations, client equipment, network switches, routers, and firewalls. Points of presence include routers, switches, servers, and other devices necessary for traffic to cross over networks. A point of presence can be as simple as a single server mounted in someone else's cabinet. And edge locations, on the other hand, are full deployments of advanced infrastructure next to IXPs, which are some kind of service providers, or they are the places where you're targeting. Now, if you really want to understand how complex signal travel in New York can be, I think you'll be able to see here that we have a borough map of New York. And it shows via the road networks just how complex everything is. In New York City, all the networks, including fiber optic, were built historically, which means they're overlay upon overlay upon overlay from the network equivalent of the old cow paths all the way up through the modern superhighways. And you never know where your signal is going to be going. And if you're in an unfortunate location, you can have a really slow rate of progress across a network. So the greater New York tri-state area is a very dense network of telecommunications, which developed historically in many layers. The result is what Lewis describes in his book. To make his point, Ryan, one of Lewis's colleagues, brought in oversized maps of New Jersey, showing the fiber optic networks built by the telecom companies. The maps told a story. Any trading signal that originated in Lower Manhattan traveled up the West Side Highway and out the Lincoln Tunnel. Perched immediately outside the tunnel in Weehawken, New Jersey, was the Iex Exchange. From Bats, the routes became more complicated, as they had to find their way through the clutter of New Jersey suburbs. New Jersey is now carved up like a Thanksgiving turkey from a network point of view, Ryan said. One way or another, the signals traveled to West Secaucus, the location of the Direct Edge family of exchanges, owned in part by Goldman Sachs and Citadel, and south to the NASDAQ family of exchanges in Carteret. Carteret isn't very far from Secaucus, but it's in that tangle of suburbs in New Jersey. The New York Stock Exchange, less than a mile from Katsuyama's desk, appeared to be the stock market closest to him. That's as the crow flies. But Ryan's maps showed the incredible indirection of fiber optic cable in Manhattan. To get from Liberty Plaza to 55 Water Street, which are not very far from each other, you might go through Brooklyn, he explained. You can go 50 miles to get from Midtown to downtown. To get from building to a building across the street, you could be traveling 15 miles. And this is part of the paywalled article. So that doesn't mean we can't show this on the video. It just means that was part of that article, if people want to look it up. So we can see here the advantage of co-location. That is, if your company's server is located at or near the server of the exchange you are targeting, you get a small but significant timing advantage. But there are other ways to gain a speed advantage in a complex network like this one. We'll get back to how routing works in the tri-state area a little bit later. So I'll keep that map slide handy. But you don't even need to front run your competition. That is to say, electronically front run, if you can engage in non-transparent trading off the exchanges. This practice in arbitrage involves large blocks of securities traded in special rooms called dark pools. Dark pools, off-exchange trading rooms. Dark pools are private exchanges for trading securities that are not accessible by the investing public. Dark pools were created in order to facilitate large block trading by institutional investors who did not wish to impact the markets with their large orders and obtain adverse prices for their trades. In other words, if you're trying to trade 1 million shares, you're going to do it in blocks, and they may be as small as 100,000, or they may be like 600,000 shares. Well, when you trade your first block, the price of the stock can move drastically as a result of that trade. And so your next block and your next block are going to trade at different levels. And this is what the dark pools are trying to avoid. According to the most recent SEC data, there were 64 registered alternative trading systems known as dark pools that were registered with the SEC as of February 2022. And this basically means that these dark pools are regulated. They do have to register. It's not at all like some of the practices that have happened that were not regulated adequately, including black bag mortgages. So why did dark pools come into existence? Consider the options available to a large institutional investor who wanted to sell 1 million shares of XYZ before the advent of non-exchange trading. This investor could either work the order through a floor trader over the course of 1 or 2 days and hope for a decent volume-weighted average price, or he could split up the order into, for example, 5 pieces and sell 200,000 shares per day, or sell small amounts until a large buyer could be found who was willing to take up the full amount of the remaining shares. The market impact of the sale of 1 million XYZ shares could still be sizable regardless of which option the investor chose, since it was not possible to keep the identity or the intention of the investor a secret in a stock exchange transaction. Quite the opposite of what blockchain tries to do, for example. With options 2 and 3, the risk of a decline in the period while the investor was waiting to sell the remaining shares was also significant. Dark pools were one solution to this issue. However, the lack of transparency actually works in the institutional investor's favor, since it may result in a better realized price than if the sale was executed on an exchange. Note that as dark pool participants do not disclose their trading intention to the exchange before the execution, there is no order book visible to the public. And it's that order book on which people can tailgate. Trade execution details are only released to the consolidation tape after a delay. While regulated dark pools are legal, and they are regulated by the SEC, they have been subject to criticism due to their opaque nature. Because dark pools, their trades are not available to the public, they sometimes have been used for predatory practices by high-frequency trading firms, using tactics such as pinging dark pools to unearth large hidden orders, and then engaging in front-running or latency arbitrage. Dark pool operators have also been accused of misusing their dark pool data to trade against their other customers or misrepresenting the pools to their clients. According to the Wall Street Journal, securities regulators have collected more than $340 million in fines from dark pool operators since 2011 to settle various legal allegations. And I believe this report was in 2022, so it's higher now. So what are dark pools in cryptocurrency for a little comparison? Cryptocurrency dark pools are similar to the pools in the stock market. They match buyers and sellers for large orders without a public order book. However, cryptocurrency dark pools may be decentralized through the use of smart contracts. Instead of trading through a trusted intermediary, the buyers and sellers interact through a blockchain-based program that executes the trade without disclosing any confidential information about the transaction or its participants. And as you will see in my talk on NFTs and stablecoins, the consequence of not having human intermediaries and having these smart contracts control what the market does without human intervention, without a trusted intermediary, the consequences can be really catastrophic. So there are both legal and highly unethical, if not illegal, uses for dark pools. In crypto blockchains and in some of the black bag mortgage derivatives markets, the problems had become only too obvious. But in Wall Street and on the Chicago Commodities Exchange, there have been some reasons for dark pool arbitrage, and these markets have seemed to benefit from the pricing stability of these off-exchange transactions and what they can offer. The lack of transparency is ripe for accusations and actual occurrences of market manipulation and full-blown rigging. So what happened in the case of the Flash Boys incident, the Flash Boys discovery on Wall Street? According to Lewis, the stock market really was rigged. Katsuyama often wondered how enterprising politicians and plaintiffs' lawyers and state attorneys generals would respond to that realization. Technology had collided with Wall Street in a peculiar way. It had been used to increase efficiency, but it had also been used to introduce a peculiar sort of market inefficiency. Taking advantage of loopholes in some well-meaning regulation introduced in the mid-2000s, some large amount of what Wall Street had been doing with technology was simply so someone inside the financial markets would know something that the outside world did not. The same system that once gave us subprime mortgage collateralized debt obligations, and I believe that was the 2008 crash, obligations that no investor could possibly truly understand, now gave us US stock market trades involving fractions of a penny that occurred at unsafe speeds using order types that no investor could possibly truly understand. That is why Brad Katsuyama's desire to explain things so that others would understand was so seditious. He attacked the newly automated financial system at its core, where money was made from its incomprehensibility. Now, again, even though this comes from the paywalled content, it can be posted. I now will go back to this. So, are the markets rigged? Do some traders have an unfair systematic advantage over others? Does a small investor really have any chance of making money in the markets under these conditions? I leave it to those who see and hear this presentation to draw your own conclusions, and we can definitely have some discussion today, and you can make your own decisions consulting with your own financial advisors. And this story is controversial. Some say the latency effects and all the other industry practices I've outlined today have little or no effect on the fairness of the American equities markets. But also there are those who conclude that the markets are rigged and they are looking for something more fair and equitable, less prone to the greed and vanity of human players. This desire to get away from the traditional markets is part of the incentive behind alternative financing. DeFi, decentralized finance, and cryptocurrency, NFTs, and the metaverse all have their roots in the kinds of suspicions raised in the book this talk is based on. The effects seen here did not stop in 2013. Some of them are said by some experts to be forces in securities markets and certainly crypto markets to this day. So finally, some concluding remarks, and then I can open up to discussion. And at that point, I will also look into chat, see if there's some interesting questions that have been raised. So Katsuyama and company, Lewis, had a pretty grim assessment. I do not necessarily agree with this conclusion, but it has been presented in a compelling way. In any event, the story and the book are fascinating reading. Serious questions are raised, and you can borrow the book from your local library and not have to pay the paywall price for a New York Times subscription, though I do like the New York Times. And it all comes down to a few milliseconds of network latency. And there are videos that have interviews with these guys, and they are just fascinating, including the CBS 60 Minutes video, but it's not the only one that's really interesting. I am going to stop my share now, and we are going to see what has shown up in chat. There was a movie called Flash Boys, and that was about an entirely different phenomenon. It had very little to do with this book, as far as I know. There was indeed a C-SPAN interview, which I have referenced. And HFT appears to be a textbook example of gaming the system. Well, yes, that is what Katsuyama, Lewis, and the others, that's basically their thesis, that folks can game the system. And this does have applications in NFTs and possibly also cryptocurrencies and definitely stablecoin. People who have more inside information can take advantage. So the question is, what do you do about it? And Jerry Slade asks, if there is a built-in delay, does the high-frequency trader still have an advantage at the precise, I believe it's the precise end of the delay? Yes and no. I really don't think so, the way they've introduced the delays, because everyone is time delayed by the same amount, and the trades are posted, especially if you're talking about the frequent call market. The idea is you post at intervals so that no one has an opportunity to see between the intervals and to trade between the intervals. Trading between the intervals is literally rendered impossible You would just simply be trading at the last value or at the next value.
But would they again get the at the posting? Would they have an advantage of getting reading the posting faster?
There is a practice called tailgating, which within a brokerage house might do that. But in the markets in general, I don't really see how that would happen because everybody sees the posting at the same time. Yeah, there'd be a little bit of network latency involved there, perhaps.
Yeah.
But that would be your receiving the signal, not you sending the signal and pinging and entering the order, all of which requires a lot more traffic over the network. Much more chance for latency effects. So maybe.
If I could comment.
Sure, follow up.
I worked in this industry for 20 plus years. Among my jobs was when I was CIO at Credit Suisse, we had the largest and fastest dark pool and wrote the algorithms that many of the hedge funds used to actually execute these trades. I know Brad quite well. I know a lot of the players in this industry and was there during the time that all of this was happening. It's really no longer, there really isn't much of an edge to this anymore. The kind of arms race has neutralized itself. And I've read the book. It's a good book. He's a good writer. He's trying to sell books. So there is very much a point of view. I think one perspective that I think it's important to remember is what was the world like before all of this happened and what's the world like now? Before all of this happened, some of us are old enough to remember when you placed a stock trade, you pay $50 commission and you had no idea what price you were getting. You got whatever the broker told you. And now you trade for free and you have so much more transparency. So the value, that $50 trade has essentially gone to a few cents. And what people are now arguing about is it ethical to take those last few cents or not? And I would argue in the scheme of things, like somebody has to make money somewhere, and anything you buy and sell, like you go buy a car, somebody negotiated that price for you. That's every market has its insiders who make money, and that's actually what makes the market work. So I think it's worth putting this in perspective and how much better and cheaper it is to execute today. And yes, there are some wrinkles way down in the details, but that's actually that's what pays for the infrastructure to make the rest of the market work. Not saying it's perfect. Transparency is good. Knowing how it works is good. Like regulation is good. Like I'm not arguing against any of those things, just putting it maybe in a bit of perspective. Yeah, so those are my broad comments. I'm happy to talk more if there are other.
So Adam, in today's market, do you think that a large trader still has an advantage over a small trader when they're both trading electronically?
Well, so define advantage.
I mean, in terms of being able to get in there quicker and get a better price.
It's a complicated question because, as you say, if I'm trying to dump 1 million shares, what is the right price? There is no right price. The right price is the best price that some other group of people is willing to pay for those 1 million shares, and it's unlikely to be a single person. And by the way, there are other ways that you can execute those trades. A bank, if you have a relationship with a bank, they may buy those shares from you at a pre-agreed price and take on the risk, the pricing risk in order, because you're paying them some other fees somewhere else. So there are lots of other ways that you can deal with block trades. So what's better? Remember that the rules say, that what's called the NBBO, the National Best Bid and Offer price, is the worst price that you should get as a retail investor. And even with firms like Robinhood that are selling your order flow to institutions, when they do that, you actually end up getting a better price than what the market says, or at least you'll never get a worse price than the market through a firm like Robinhood. And you can argue if it's ethical or not that they're selling that flow or not, but you strictly benefit compared to getting the market price. And I'm not sure people really appreciate that fact. Should an institute, so an institutional investor wants certainty. because they want to know. And remember, that institutional investor is probably trading on your behalf. They might be managing your pension fund or your 401k or your mutual fund. And so, again, there are the real beneficiaries aren't just sort of rich hedge fund managers. So I'm not sure I can even answer that question, Bob. It's no different than does Walmart able to buy a widget at a better price than you? Sure, because they're Walmart. Is that unfair? No, like Walmart wouldn't be around if they couldn't get a slightly better price. That's how they make their money.
There have been questions about Walmart's dealing practices versus smaller shops.
Right, but you know what I mean? Like institutions do get to play, but because of the nature of their trading in any business, they use some different mechanisms.
I think a related question asked by Charlie Holbrow is, so how can we game the system? Or can we?
Are you asking me?
If you have any insight or anyone else who
No,
knows.
I don't. Look, no, be informed, but ultimately you're talking about, I mean, even back in the 2000s, 90s and 2000s, when this was at its peak, the phrase was picking up nickels in front of bulldozers. This was a business that only worked for a few people at massive scale, and didn't work hugely for very long. So all of this, quote, gaming the system was all about razor thin margins at massive scale. If you want it, it's quite hard to get into that game, and I'm not sure that it's worth it anymore, compared to just making good investment decisions. If you can pick stocks well, awesome, good for you. Go do that. And if you can pick stocks well, worrying about a fraction of a cent of price improvement is really not fundamental to am I able to pick good stocks that I'm going to hold for weeks or months or years.
Okay, thank you for your expertise, Adam. One comment that has been made by Jerry is about Robinhood and Citadel, and that these are examples of where payment for order flow feed retail transactions into dark pools really moved certain stocks. And John Stewart covered this in his show recently. And if anybody has anything to ask or say about Robinhood, I don't know about it. But anybody have any further comments about the Robinhood stuff?
Just to say that, again, you do, as an investor, receive a better price. You may not like the practice, and you're allowed not to like the practice. That's fine. But you will actually get a better price than the market by this practice.
Jerry?
Adam, this is Jerry. I didn't know that part of it, and so this is all good information.
So go look up
insider information. I appreciate it.
Yeah, go look up. It's called Price Improvement, and by all means, go check me on this.
I'm planning on reading more about it.
Yeah.
Thanks.
What they're doing is they're saving money by routing this flow. They're saving exchange fees, and they're essentially splitting that savings between you as the investor and themselves and Citadel. It is. But again, you can like it or not like it. You can do business with them or not. You should absolutely be informed about it.
Appreciate it.
Okay. A little change of direction. Ted put a comment in that there's an ad which runs on financial programs, which compares the range Y in execution prices for free executions or by operators of various types. And Ted, since you have your hand up, is there something you want to add or ask?
Yeah, so I think the name of the company that runs the ad is called Interactive Brokers. And their ad basically says, okay, you can pay us and we will guarantee you something that you can't get if you work with a enterprise that offers it for free, essentially. And their comparison is with Fidelity and Schwab and with I think one or two others that are big investors and also handle small investors. So that, you know, it's a complicated relationship. Obviously, if you have an account with Fidelity like I do, you can have mutual funds and you can have individual stocks. And there was a fairly well-known event that occurred when General Electric did a reverse split and went from being a price of a few dollars a share to $100 a share overnight, basically, in order to make, for some reason, their company more marketable as to investors or something. And obviously, if you were probably almost any pension fund participant, Fidelity had a piece of your action, more or less likely, and they had a huge amount of General Electric shares. And if you tried to essentially do this arbitrage kind of thing, you were arbitraging against potentially your own account. Fidelity can match all of these individual transactions against the block that they've got that they have to sell in order to meet the requirements of maintaining a certain balance in the way that their pension fund, is structured. That, let's say you're a big union or something like that, you've got particular mutual fund type accounts set up with Fidelity, and Fidelity is managing a lot of money for you, and they can see the same price action that all, independently of what's on the actual exchange, because they have this essential private exchange they're running. And I think interactive brokers is trying to claim they can get you a better deal, even though you have to pay for it. So not $50 for a transaction, but it's a couple of dollars a transaction. So if you're buying one or two shares, it doesn't make any sense. But if you're buying a few thousand shares, and you could buy a few thousand shares of General Electric when it was, nominally it'd been around $10. It was down to around, I think, $7.50 or $8 when the transaction was announced, and then it went back up to about $10. So it became a new company at 100 and something, 114, I think it was, or something like that. So you clearly could have played that game and see what you got out of it, and then price slumped back down because of the recent decay of the price on the S&P down to, I think it's in the 65 to 70 range recently, but it's still way above when it was $6 or $7 a share. But the difference in the number of shares would make a difference potentially in terms of the fee you'd pay if you were paying interactive brokers versus with Fidelity that essentially let you do it for nothing. So I think there's a lot of that going on. And Fidelity is managing trillions of dollars of people's retirements. And
Okay. Yeah, I didn't mean to cut you off. Anything else?
Well, I think that's a part of the story that's not included in what you were relating to, in a sense, because the vast majority of these big institutions are obligated by their fiduciary responsibility to the people who have put the money into their hands as to how they can operate. They can't, if they say this account has 90% of it in the stock market at all times, if something happens and they have to sell some of the shares or whatever, they can't just sit on the cash. They have to reinvest it. And so they, oftentimes are looking inside their own arrangements that they have, so I have basically with Fidelity an IRA. I have with Fidelity, I have mutual funds that are personal mutual funds that are outside the IRA, and I have with Fidelity individual stocks, and they're all sitting in some fashion in one database that's accessible to the company when they're making the transactions. So I think it's much more complicated than just
Sure. Yeah. So
latency. things like that.
Ted, I
It
think
is.
Go ahead, Adam.
there's a couple of things in there. What you're talking about, I think, with Fidelity is the practice called internalization.
Yeah.
Which is that's exactly right. If you happen to be selling 100 shares of Apple and one of their big funds is buying Apple, they may just have the fund buy it directly from you. And again, they're saving money and they have to do it at the same or better price than the market. So theoretically, everyone benefits. The company you're talking about, IDB, they've been around a long time. They're a good company. I know them well. They're owned, I think, by Monex, which is a Japanese bank or Japanese capital markets firm. They're really aimed at more, slightly more sophisticated traders, people who work self-employed, but they trade very actively during the day, day traders, as they're called. And think about it like the difference between a Mac and a Linux box. With a Mac, you sort of say, I just want to get something done, and it takes care of it. With Linux, you can go deep and set all kinds of options and be a bit, get a bit more into the operating system. They're a bit more like the Linux box. You can execute the trade, but you can also kind of have lots of options, which include where the order might get routed, what rules you allow for execution or don't allow for execution. So there's a bit more power in the platform, but ultimately they're doing the same job as Fidelity. They're executing a trade for you. They're just giving you a bit more control if you're a more knowledgeable trader. And that can add up if you're a very active trader and you're trading many stocks in and out during a day. That difference can add up over time, particularly if you're trying to play, you're trying to understand the supply and demand of a stock on a given day and things like that. They can give you that information and help you act on it.
Okay, I think that covers that pretty well. Thank you.
Want to make one more point on that, because the other thing to think about is how thickly or thinly traded that particular stock is, and it makes an enormous difference whether or not you're talking about a stock that everybody holds.
Yeah. Okay, Ted. There are lots of details. I would like to get on to other people's questions. Sorry to cut you off. Barry is asking, isn't gaming the system a fundamentally unethical practice? And I did indicate some of these practices I was talking about are considered unethical, though they may not be illegal. And as Adam said, well, maybe sometimes, maybe not. It depends. So Mitch makes an interesting point about price improvement, which we were talking about. He posted price improvement, PI, occurs when your orders are executed at better prices than the best quoted market price, known as the National Best Bid Offer, or more commonly, NBBO. Just wanted to make sure everybody understood that. Thanks, Mitch. Barry again. The solution appears to be a requirement for ethics, but legislation and regulation are too primitive a mechanism to define or enforce ethics. Barry, would you like to elaborate on that a little bit?
Yeah, I'd love to. We'd like to have a market ideally that's fair, efficient, and ethical. That would be sort of the ideal market. But there are practices which you can adopt to get at least a short-term competitive advantage, which you don't know whether they're going to turn out to be ethical or not, because you can't predict the long-term effects. But if one very clever participant in a market adopts a strategy, a practice, which gives them an advantage, sooner or later, other people are going to recognize this practice, this tactic, and adopt it themselves. And as soon as you have lots of people adopting the same advantageous practice, you can end up creating an unstable system, which is essentially what happened with So it turns out to be unethical. When everybody does it, it creates instability, which is the opposite of what you wanted, a fair, efficient, and ethical system. And the problem is that if you try to regulate this with legislation and regulations, the regulations and legislations aren't any better than anybody else at foreseeing the long-term dynamics of these practices. And so you have these cycles of people introducing practices which turn out to be unethical and undesirable, but unpreventable. And so you have this, it's sort of like the Shannon-Nyquist sampling theorem. When you have all this high frequency stuff, the data looks like noise, so you can't model it. because you can't get enough information to see the patterns. And if the pattern turns out to be unstable, you can't find out until it's gone unstable.
Okay, well, that's an interesting point of view, but the problem always remains. We have to be able to do something, even though government awareness of technology always lags behind technology people.
Yeah.
And the results can be questions being asked in hearings that are absolutely nonsensical. And, like this famous time when one senator asked, why can't we get the pH of the rain down to 0? That sort of thing. Total misunderstandings. So anyway, yeah, but we got to be able to do something.
Yeah.
We've got to be able to do something. And the best we can do is try to educate those who govern us and elect those who govern us who are well educated.
Yep.
Not those who deliberately deny science and deliberately deny technology.
Yeah.
So
how do you find out who they are until after they've revealed themselves to be crooks? You don't know in advance.
Sometimes you get to know before, sometimes you get to know after.
Right.
After there are some remedies. People don't have to be reelected. But anyway, before I get to Dick, Frank Jens said, can we give some commentary about net neutrality proposals and what they're trying to do and prevent? Well, I wanted to make a distinction between net neutrality on the internet and these specific network effects in and around New York City. These effects are more like telephone networks, and they're data networks. They really aren't the internet itself. Even when you're talking about Chicago to New York, that's almost a dedicated line. And you're not really talking about internet effects. And you're not dealing with ISPs. The telecom companies, for example, are not, to our knowledge, not deliberately throttling one brokerage firm or favoring another. Exchanges, however, have accepted payment for direct lines, which are direct access. These are fast lanes. And as long as it's out in the open, it's been held to be legal, even if it may or may not be ethical. Dick, did you have something to ask or add?
Yes, I'm not sure how articulate I'll be about this, but it's sort of an overarching consideration that I've been mulling in my head for the last 10 or 15 years. And that deals with this whole, what I think is growth in the various ways in which investors have invested their money in order to make more money, and the growth of the various funds and the various ways in which this is done. And I've come to think that things such as hedge funds are not good. I would prefer that they be illegal, things like that. And the reason for that being is that it seems to me, and you and Adam can tell if this is true or not, more and more of our resources, human resources as well as physical resources, are being put into the whole investment aspect of life. That's sort of the way that New York in lower Manhattan functions. And that bothers me. And the reason it bothers me is because basically what you're doing is you're taking what are really important in society, that is goods and services. Those are really what you're playing with, and that's important for society to function. And now what you're doing is you're putting a lot of resources, tremendous billions of dollars, into playing with the way that you financially function with those resources. In other words, people like hedge funds, managers, commodity funds. Well, commodities go way back to agriculture commodities, and I wasn't too much opposed to that, but now I'm beginning to become more opposed because commodities have gone beyond agriculture. It just bothers me that we're spending so much money, investing so much money in financial services, let's call it, rather than really what's basically important for society, to me, which is goods and services. Would you and Adam care to comment about my concern?
You mean the amount of resources that we're devoting
Yeah,
to investment?
we're spending a lot of money. I mean, to me, it's really been increasing over the course of the last 10 years, if not more.
Could I comment on that? Movement of money through the capital markets is part of the industrial production. And if you limited movement of capital, you'd have much less industrial production, and you wouldn't have capital going to the quote most desirable, whatever that means, the
Yeah,
most
but now we're
desirable
down.
points.
Yeah, but now we're getting down into microseconds. You can move.
Well, I'm not
capital
talking about that.
without
I'm
going
just
to
talking about the
microseconds.
capital markets are essential for a capitalist system. And if you just said, if you buy something, you can never sell it, the capital markets would be absolutely frozen.
But why do we have to spend so much money trying?
You're not
to try
spending
get-
it.
Yes,
You're
we
not
are.
spending it.
Yes, we are. We
You,
are.
not you aren't.
Yes, I am.
How are you
Well,
spending it?
Jerry,
I'm paying the people who are doing the investing for me, and I'm paying the companies who are doing the investing. I'm
Well, that's
paying
true,
the
but
people who are
if
investing
they
in
weren't, you'd be
them.
stuck with your capital and you could never move it, and it would
I
not
don't
find
want
its
to
place.
spend money on
Jerry-
people who
Jerry
are
and
investing
Dick-
for me.
Jerry and Dick, this notion of who pays when these fees are charged is quite debatable, and who ultimately pays, whether it's a benefit or not. It has generally been assumed in our capitalist economy that there is a net benefit, whereas in other points of view, it's considered economically unproductive activity or even economically counterproductive activity, and it's frowned upon or even banned. We happen to live in a country where it's encouraged. I think we have to leave the debate there, whether we agree with it or not. But Mike has his hand up.
Yeah, to Dick's point, which is something that I've thought about or worried about for a long time. The one way of looking at the point that Dick is saying is the fraction of the economy that the financial sector actually occupies. And that has gone up and up and up. That happened in England. And you know what happened to England? You know, England basically declined as an important power economically.
You're
Our-
referring to the,
our,
you're
our
referring,
resources are going, the size of the financial sector is a marker for how much of our investment or our free cash or whatever is going into different sectors. And we are not investing in the means of production and in innovation.
Mike, you might in England have been referring to the mercantile capital system where they
No.
were using, something
No.
else?
No, I'm talking about 20th century England.
Okay.
Losing India didn't help.
No, losing India was irrelevant to the point I'm making.
To counter that, look at what's happened in East Cambridge, and that's all due to the movement of the capital markets. That's not due to scientific innovation. That's the capital markets funding that entire development, and it is staggering. And the benefits of that have been staggering as well.
I would argue that point, Jerry, very strongly, very strongly.
You don't think the capital markets are what enabled all these startups in Cambridge to begin?
No, the reason is because of the technology that existed in the educational institutions there, plus the fact that you had other people who were just willing to go there. It is chance that it happened there. It wasn't because of capital markets, it was chance that got there. You talk to people at MIT about this. They've been investigating this. Why did it go to Cambridge rather than San Francisco area?
Well, there
Because
was
at the time in the 1970s,
$500 million.
those were two areas that were equal.
Well, I'm not talking about Cambridge in particular, but what I'm saying is that when you have a startup and you simply require capital, it is the capital markets that provide that capital. It doesn't come from nowhere. It doesn't matter how smart you are and how much technology you have. If you can't pay for it, it isn't going to happen.
I'm not talking about capital per se. I'm talking about the same thing that Mike is getting. That was my main point I'm trying to do, is how much we're putting into this whole function of the capital market. I'm not talking about capital per se. I'm a capitalist. I love it. But I'm concerned about how much we're putting, how much of our resources is going into that aspect of regulate, or not regulate, but just the function of the market itself.
Yeah, we're paying more to get the same amount done.